Let's take a look at this number. This was a much stronger number than had been anticipated. What do you think immediately as a voting member on the F.O.M.C.?
Yeah, my immediate reaction is that this is very strong for this month, but you got this big revision for last month, and you've got some noise in this data. So, broadly speaking, average over the last 3 months sounded to me like that came out to 241,000. That's a very strong jobs market, but we knew that. I think at this stage in the cycle, looking at low unemployment and the jobs growth is maybe a backward-looking signal.
Jim, I have to say, you look pretty confident and pretty comfortable right now. You are somebody who had been saying for a long time that you wish the Fed would slow down a little bit. You feeling really comfortable with this latest statement that just came out from the entire committee?
I thought this was a very good decision by the F.O.M.C, and I think it set us up for very good couple of years here going forward. We have normalized rates in an environment where our main competitors overseas have not been able to normalize rates. We've kept inflation close to 2%. But now it's time to wait and see how the economy develops. And I appreciated the way the decision came out. So I think we're in great shape right now.
Jim, can I just say, you started that out with saying you think this sets you up for a very good couple of years. Is that to suggest that you think the Fed would be on hold for the next couple of years? Or is that to say you're just talking about the broader economy?
I think this concept of being on hold, I would like to think that we're out of the business of penciling in further increases that have to be made. I don't think we're in that game anymore, but obviously we will react to data as it comes in. So if the economy performs better than expected or worse than expected going forward, we're willing to move in either direction. But there wouldn't be any presumption now anymore that we're going to move in one direction or the other. So in that sense, I think the level of rates is very good where it is today.
Jim, give us your broad view of the economy here. The market seemed to be certain there was going to be a very slow and sharp downturn. The Fed penciled in slowing growth, but not necessarily slow growth, at around 2.3% is the consensus. We keep getting these decent jobs numbers. I see them as more coincident. I guess you see them as lagging. Either way, what's the broad outlines of the economy here and the outlook for growth as you see it?
Well, there's a near universal view that the 3% year-over-year growth rate is going to have to slow down to the potential growth rate of the economy. So nearly everybody has the economy slowing down in 2019. That doesn't necessarily mean anything bad for the economy. It just means you can't grow above trend forever. So I think that's basically where we are. If you look at recession probabilities, they have ticked up, and that's because of yield curve issues. That tends to be a good predictor of recessions for the U.S. But now with the Fed having made this decision, I'd look for some steepening possibly in the yield curve, and we get to a better situation on that dimension.
Jim, I asked this of the chairman. I wonder if you'll answer this question. Is it time now to reduce the runoff of the balance sheet? And can you give us a number where you're comfortable with the balance sheet going down to? It's $4 trillion right now. Where are we going, and how quickly are we going to get there?
Yeah, we put out a statement on that to try to clarify where we are. We're doing a lot of work on this. I'm hopeful that the committee can reach a decision soon. I don't want to prejudge where we'll come out, but I will say that in the big picture, reserve demand is going to be much larger today than we appreciated maybe even 1 or 2 years ago, and certainly much larger, even an order of magnitude larger than it was pre-crisis. So I think everyone has to adjust to the fact that these reserves are being held for new reasons, really to meet the liquidity coverage ratio and other reasons. And so we're going to be very cautious about getting down to this, to the right level of reserve demand in this environment. And also we're going to run a floor system, so we're going to want the funds rate to be trading right at the point where reserves are satiating the system. So there are a lot of technical issues here, but the balance sheet is definitely going to be bigger than it was, and I think bigger than even we thought it was going to be last year or the year before.
Hey, Jim, it's fair to say, I think, that the tone from you and your colleagues and the chairman has changed much more over the last
Not
3
from
months
him, really.
than, say, the U.S. economic data has. To what extent has that been influenced by international economic data, and in particular what other major central banks are doing or not doing?
Well, I think we've taken on board that the global situation has not been as robust as it might have been hoped. Europe, in particular, has been weaker in the last second half of 2018, and China. It's always hard to interpret China, but it looks like it's growing more slowly. Certainly, anecdotal reports are that it's growing more slowly than anticipated, and that they're trying to cope with tariff negotiations and other matters. So. We take that on board. In 2016, worries about China put the Fed on hold for an entire year. I don't think we're quite in that situation, but it shows you how important these factors can be in monetary policy deliberations, even here in the U.S.
Jim, as I said, I'm sure you got a bounce in your step because you were so ahead of the curve on this, which was the opposite of the way you were before that, which is pretty amazing. But if I asked this the other day, if someone told you that Fed funds added to unemployment rate, what was the third thing that I was
inflation.
adding to? Added to inflation would total 8 or 9.
Under 10.
Would be under 10. Could you explain what is happening in the world, the top 3 things that explain that for me, please? Because it just doesn't seem...
I think, those 3 numbers adding up to such a low level reflects the global low-rate regime that we're in. I do not think we have left this regime. We've got Europe and Japan still with negative policy rates today and unlikely to move anytime in the near future. We have raised rates in the U.S. on the strength of upside surprises in the economy in 2017 and 2018. But now, like I said earlier, most people are expecting the economy to slow down somewhat. And so, having a funds rate at 240 in a world where the rest of the world is negative, I think that's pretty high rates and probably the limit of where you can go. So I think the fact that the U.S. is growing faster is great, and the fact that we're up at 240 is really pretty high in a low interest rate regime world.
Jim, I don't know that we have time to explain this, but what's remarkable, I think, about where you are right now, and the reason why I think Joe says you ought to take a victory lap, is not because you pegged what was going to happen, but because you have a different idea of how to think about the funds rate, which is to get to a new equilibrium rate and then kind of go straight. And we're going to see you, I think, in a couple of weeks. We can talk more about that. Yeah. But I want to just switch real quickly. The market is trading more or less with no chance of a rate hike over the next year. But to the extent that it is trading with some bias to it, it's to the downside. It's a cut. Do you think that's right, or do you think that it ought to be, where should the market price where the Fed is headed right now?
Well, if you followed my dots will say that we just have a flat outlook for the future. I think it's a good way to think about it. And we will react to data as it comes in. You can place your bets. All the traders can place their bets as they wish. Some of them might argue that the U.S. economy, this jobs report looking very good, they might argue that the U.S. will surprise to the upside. Others might say that those global factors will come back to bite us, and maybe the U.S. will slow down faster than we're hoping for here. And so, but from the policymakers' point of view, what we want to do is project a flat rate, and then we'll see what happens with the data.
Hey, Jim, how much of the Fed's kind of new dovish take on things is a reflection of some of the immediate issues facing the economy and the nation at this point? And I'm thinking of the March 1st deadline for these trade talks with China, thinking about other issues that are out there, like these wall negotiations and a potential shutdown for the government again. How much of that plays into what the rest of the F.O.M.C is looking at and thinking, okay, let's hold off?
Those are certainly factors. There's a long list of worries. We get paid to worry, so we're used to that. We have to see how this China negotiation works out. see if they can get to some kind of agreement. It does seem that both sides would benefit, but you never know in a negotiation. You've got Brexit sitting out there. Reading that from a distance, I can't see what the resolution will be, so we'll have to see with that.
Jim, do you ever just say Amazon for why everything is happening and whether, that explains it? And I don't know, does that counteract wage push inflation that we could eventually get?
Joe, one thing I would say, people talk about tight labor markets, but my point is that the feedback from tight labor markets to inflation is extremely weak right now, and it has been weak over the last 2 decades. And just to put a number in your head, the ratio is 10 to 1. You have to have a gap, unemployment gap of 100 basis points just to get 10 basis points of inflation. That's a very weak trade-off, and the kinds of gaps that we're talking about aren't going to generate very much inflation.
Jim, we're going to have to go real quick, but how far would you let the unemployment rate fall then before you started to get worried?
It can go a long ways, and you're not going to get very much inflation.
3%, 2.5%?
You can go down.
Dead.
Yeah.
Well, you can go down, way down. You can go way down, and you're not going to get very much inflation
2.5%?
unless there's nonlinear effects, and the evidence for that is very weak.
Everybody should go to the St. Louis website, read Jim's slides, because they're very understandable.
We've got to get to the other Jim. Jim Bullard, thank you. And I can't wait till you're on again.
Thanks for having me out. Thank you.